Data from StatsSA has confirmed that the South African economy effectively did not grow in 2024. According to StatsSA, in the fourth quarter of 2024, South Africa's GDP grew by 0.6%, meaning that full year growth came in at 0.6%. This is down from the 0.7% that South Africa achieved in 2023. Now, that is an improvement in the fourth quarter on the 0.3% contraction that the economy experienced in 2024, but largely the 0.6% fourth quarter growth and 0.6% yearly growth for 2024 confirms that South Africa's longer term low growth status quo is now in place. Between 2012 and 2023, the South African GDP averaged only 0.8% growth per year. We should also keep in mind the impact of this on South Africans' economic worth or their economic ability to impact the economy, to create value, to improve their quality of life, that of their families and that of their communities. If the economy of a country grows less than the population of that country grows per year, real GDP per capita effectively declines over time. So from July 2023 to July 2024, South Africa's population growth rate was 1.33%, much higher than the 0.6% that GDP growth that GDP experienced in terms of growth last year. So this again confirms that GDP per capita in South Africa has declined. And if you go according to World Bank data, in 2023, South African real GDP per capita was $6,022. This was lower than the $6,591 measured in 2007 in constant dollars. So from 2007 up to 2024, South Africans have become poorer over time. Another important indicator, the most important number we consider in terms of analyzing the South African economy, is the rate of gross fixed capital formation as a percentage of GDP. Gross fixed capital formation represents investments in heavy plant equipment and machinery, in roads and bridges, and other real assets that are relatively more difficult to take out of a country if, for example, you're worried about your property rights. A higher rate of gross fixed capital formation indicates a real measurable confidence in a country's future growth prospects. In this regard, the 0.7% gross fixed capital formation decline in the fourth quarter indicates that despite the positive sentiment generated following the formation of the Government of National Unity, higher levels of hard investment in South Africa are yet to be seen. The formation of the GNU afforded lots of positive market sentiment to the South African economy, but it very much risks being a sugar high only and nothing more substantive or positive or nutritious for the South African economy if pro-growth reforms, especially in areas such as labor markets, aren't sped up, as well as reforms to the network industries of electricity and Transnet, where you've got effective state monopolies, even though it looks for the time that Eskom has things in hand. Because the electricity market is so concentrated, we're concentrating all our eggs in that one basket. And if you know anything about risk analysis, you know that concentration risk definitely is not a good thing. We're also seeing at this point a separation between positive sentiment and real meaningful positive economic activity, investment, and higher consumer spending. Those are the things that you would look for if you were going to say South Africa is on a different, measurably, clearly different path. Yes, there have been elements of reforms and overtures towards reforms, but not to the extent that is necessary to lift South Africa out of this now longer and longer growth trap in which it finds itself. We can also look at things like the postponement of the budget, indicating just the fiscal pressures in which South Africa finds itself. That is, of course, one area to get out of. One method to get out of that area, that particular bind, is by attaining higher economic growth. But is the political will there to make the necessary difficult political decisions? Thanks very much for watching. This has been Chris Hattingh for the Center for Risk Analysis. Until next time, take care.